All right, guys, welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. Very important update today. Going to go through a quarterly review of the Crassus Investment Portfolio, excuse me, which is the main portfolio on eToro that you'll be familiar with. So I run a derivatives book personally outside of that. And so today, this is my public portfolio, the one that everyone comments on, and I have a great deal of interaction. So a whole lot has happened in the month of April. It was a humongous month. And so we're going to talk about what that was and what that means for equity or capital markets moving forwards, and where I see things going and how I'm going to position. We'll talk about some of these things listed here. So here's a brief contents. If you haven't already liked and subscribed to the channel, guys, I would appreciate you doing that. We're going to talk about the portfolio itself, so updates that I've made to it and how I'm going to be positioned moving forwards. But in order for you to understand why I'm doing that, we're going to talk about some of the macro environments, headwinds and tailwinds that I see and what has made me make those changes. Using Zoom today, guys, so hopefully you enjoy it. It's getting a bit old with Loom not seeing my face. So here you are, you get to see my face. I've been banished to the other office, so as not to disturb other people, my dear partner, namely. And so here we go. We've got some changes to the construction in the face of the portfolio in the face of changing credit markets. So what's happening in credit markets? You all would have heard by now interest rates are going up, but most people don't know what that means. What that means is the bond market is increasing in terms of its yield, which means it's decreasing in terms of its price. Now, why does that matter? Well, over the last few years, we've had a lot of government's initiatives, okay, causing deficit spending. Central banks need to back that up somehow, and they step in and they buy up all the bonds. So government owes various entities lots of money. That's what a bond is. And then in order to make sure the rate of interest that they have to repay on those obligations stays fairly low so the government can service it, the central banks, if no one else wants to buy, the central banks will make up more bids, buying up the price of these bonds so that the interest rates that they have to pay, okay, they will, as a yield, start to become very, very low. And that's where the credit markets take their cue from. They will borrow based off these rates, Fed funds rates and US 10 years used as a discount. And so if you're a banking institution, you will borrow money from another institution or government or central bank, and you will then lend that out at a higher rate. So if it's at, for argument's sake, 0.25, where the Fed funds rate is, you'll need to lend that onto your customers at 0.75, okay, or 1%, whatever the spread will be, okay? So if you look at government bond yields, normally they will increase with time. So the 2-year will pay you less interest, or less interest than the 7-year, less interest than the 10-year, and so on. And if you're in a corporate bond or private institution, you will be charging more, or you will be paying out more interest, okay? If you're lending it out, if you're the buyer of that bond, you'll demand a higher interest rate to take the risk of a corporation over a government, okay? And that's where the interest rates start to really be affected. And why is that important for us? If we're talking mainly about equities on this channel, and what that means is our discount rates will change. So normally if investors around the world using a risk-free rate of the 10-year, and that has gone from being 1%. So instead of discounting cash flows that businesses or stocks will produce at 1%, now the treasury yield is just ticking over 3. So you've increased the discount rate by 3 times, okay, 1 by 3 at 3, and that's going to have a significant impact on the valuations, okay? So if you've got a risk-free rate that's a lot higher, why are you going to use the same discount rate for these uncertain cash flows in the future? The answer is, of course, you're not. You're going to adjust what you will pay for that stock. And that's what we're seeing around the market. We're seeing markets sell off in the face of these rising interest rates, particularly in the risk-free rate that most people use, which is the 10-year treasury. You can see my other video that I made about the US dollar. I cover the treasury there. So the bond market increases discount rates. We've talked about that. The low multiples and debt levels strategy that I've been running is starting to pay off, because yes, everything will get sold off initially. So we've had a down month for sure. We've outpaced the index because I haven't been buying high multiple companies, and I haven't been buying a lot of companies with high debt levels. So those the companies we own have strong balance sheets for the most part. We'll talk about the exception. They are not so worried if the debt rate starts to increase, because they don't have much debt to repay. But you will see investors value them less because the discount rate which they're using to value the companies has risen. And so we have always, on this channel, I've spoken a lot about how I have been very disciplined about the valuations paid. Instead of paying 20, 30 times earnings, we've been paying more like 10 to 3 in some cases. I want to talk about this. So this is the key. Don't worry about where we are now. What's going to happen in the future? We've got to position ourselves for what's coming, not what's past. Where's the institutional capital going to leave, and where's it going to enter? Because we want to be ahead of that. We want to be, if there's a wave of capital coming into a sector, we want to be in front of it, and we can therefore benefit from this new capital bidding up the prices of assets that by then, hopefully, we've been smart enough to own. So I think it's pretty straightforward in terms of where's the capital leaving. The capital is leaving the bond market. Okay, that's undeniable. And I think it's also leaving the higher end multiples, the stuff that we haven't been touching, with high debt levels and low earnings and high multiples on the earnings. It's leaving that sector. And the question is, where's it going to go, and where are we going to position ourselves to benefit from that? Some key targets, I'm going to talk about that. And portfolio construction. So as always, we're looking for high free cash flowing stocks. We'll talk about our price to earnings ratio on the portfolio versus the S&P. Commodities, some shorts. So I've taken out some short positions, and our cash. So the portfolio has changed due to macro changes. The update. So everything was going very well, and we were positive on the year. And then April came along, and we had a down month. And we still outperformed. We're still outperforming the index over the year, but you never feel good about it because we had such an annoying down month. 8%. 8.5% versus 8.8% for the S&P. So this in the long term really doesn't mean anything, guys. It's 1 month, and it's price action. It doesn't say anything necessarily or per se about the assets that we own. We own assets that produce a lot of cash flow, and that is the key. Adjusting for dividends, okay, we've performed better. And I know I complain about this all the time, but we don't get dividends added back into the portfolio performance. So my performance always looks worse than it actually is, which is very annoying, but it is what it is. And if we adjust for foreign currency, so in Australia, we've had our dollar depreciate quite a bit, from 74 cents to 70 cents, and will likely go lower depending on what the RBA does moving forwards. So that's actually been a benefit from you. It's taken some of the heat off the price action. So if you're an Aussie copying the portfolio, you're actually more like -6, and depending on when you got in. Okay, so you can take 1 or 2 percentage points back off the underperformance or the drawdown. Why is this important? So this is purely talking about the price of some of the assets that we own that have been marked down in this current point in time. Until we sell, we haven't lost anything. Okay, people talking about, oh, we've lost a bit. We haven't lost a single thing until you choose to crystallize the losses. And so the article I wrote earlier in the piece says, what should we do? Should we sell a business such as Royal Mail Group that's providing a heap of free cash flow? It's about to earn itself back in 3 years. Should we sell that now and take a loss? Or should we just hold tight and get that cash flow? If you had a house, you had a piece of real estate that you were renting out, and you bought it at 100,000, let's say, and you had a free cash flow yield of 30%. So let's say after your servicing and your overheads, every expense, you had 30 grand's worth of rental payments to you left over. If someone then offered you 50 grand, would you sell the house? Would you look at the market and say, oh, we've lost 50% of our asset? No, of course you wouldn't. You'd say, well, this is insane. If we can buy another house in this position, we'd gladly buy it, okay? 30% cash flow yield is great. That's the situation we're in, or similar, with a lot of the assets that we own, okay? So do your best not to get disturbed with price movements. Focus on the valuations of the companies. So what did I miss? Did I miss anything? I would say, to be critical of myself, I would say I absolutely nailed exactly where the macro picture was going, and I didn't take enough action. And that's very, very annoying. I thought the speed of the Fed action has surprised me a little bit. If there's anything I've missed, it's probably been that the Fed has been so quick to act with their rate hikes, expected them to, and we'll see that slide in a second. But I think my lack of conviction in going after the credit markets hard in about December last year, I should have taken out a big short position, and I just didn't, because this isn't my own trading book as such. This is something that I got a lot of people that I know copying the portfolio, and so it's for just the long term. Shorting is in many cases just getting too fancy. And if we think about long-term compounding capital over time, these little drawdowns don't mean much. And that's why shorting to me is not something I'm really keen to do unless I have a good reason. I'm going to talk about why I've taken out some shorts in a moment. Free cash flow yields and dividends are holding us in good stead, and I've spoken about that. And we always stop and ask yourself, what are we trying to achieve? We're trying to buy good assets at good prices. We want to buy assets when they're on sale. We don't want to buy them when everything feels good because they're going up. That's the tendency, but obviously arithmetically that doesn't make any sense. So you have to take your emotions and completely invert them. When you're feeling bad, you should be feeling good because you get to buy an asset on sale, providing obviously you've done the due diligence correctly. And when you're feeling really good, you should start to be a little bit nervous and potentially look to rebalance. Now, obviously that's an oversimplification, but it's something we need to keep in mind. Direction over the timeframes. We're not looking at monthly timeframes. We're just checking in, and I will be looking to add some funds. Okay, so I'll be copying the portfolio. I would like to add some more funds to the portfolio, because if we're going where I think we're going this year, and I think a lot of assets across the board will be just sold off indiscriminately, and I will not be panicking. I will not be selling in with the crowd. I'll be selectively looking through that broad index that's being sold off and saying, what's on my my wish list, and can I buy it at a price that I really want? Great. If it's at a bargain, even better. Okay, so this is a slide that I wrote in the end of year presentation, so 2021. I haven't touched this other than the blue text here to say it's the old slide. I predicted short-term rise in US 10 years, okay, or bond prices weakening. Tick, that has happened. Gold to weaken, and then the pattern to reverse. So gold has certainly weakened off the back of that. Will the pattern reverse? Remains to be seen. I think it will. The Fed to taper QE, that's happened, and then resume it eventually. When will that happen? Around the next problem that we have. Okay, once we start to, I think they're going to raise rates until something breaks, and then they're going to completely reverse course. I don't know when that will be. It might be an economic recession that's really brutal. It might be a stock market crash. It might be surely not another pandemic, but it could happen. It'll be some sort of recession, and then they'll ease up and say, oh, sorry, we pushed too hard, and they'll reverse course a little bit. Will the commodities bull market kick off? It certainly kicked off the quarter, this first quarter, so tick. Active management to come to the fore. I'd like to say tick, but I probably should have taken out the shorts. But if what you've seen across the board is, even with April being drawn down 8%, the entire index, the S&P, is down 13% this year. Okay, so you're still outperforming, even though it's negative. And look, if we hadn't have had the April, prior to April, I should say, my derivatives book was outperforming by nearly 15% alpha, and this particular eToro was outperforming by a bit less than that. The cap weighted indices to have a reverse flywheel effect. We've seen that, and I've been hurt by that a little bit in terms of nano dimensions, where you have these ETFs, these broad index trackers. They have redemptions, and every time someone pulls their money out of these funds, they have to sell off every single piece they own proportionately. And so it doesn't matter whether there's good news or bad news with the business, it just gets sold off. And nano dimensions would be a great example of that, where you have basically $5 worth of cash for every share on the balance sheet is being currently offered at the market for about $2.90. Okay. So if you've been holding it for a long time, it doesn't feel good because you've been smashed in terms of your valuation. And we're not doing too bad, or down about 30%, which is annoying. But we look at it and say, look, I'm not going to sell $5.80 for $2.90. I mean, I'm not going to do it. I'll buy it, but I won't sell it. And inflation, the question mark. And yes, we did see inflation. So very annoying for me when it comes to the Toro portfolio to have seen more or less exactly what's happened. And some positioning has been good, but it could have been a lot better, I think. I think I was too conservative, not wanting to take out those short positions. That would have made a massive difference. And so I've started to become more active and just managing how I would in my hedge or my derivatives book. So the game plan for 2022, this is the same slide, just updated in the blue text. We're buying assets for less than their worth. Yes, about 30 positions across the sector. We currently only got 24 longs and 2 commodities contracts, and we've got 2 shorts. Okay, so a little bit more concentrated. We're holding more cash. We'll be overweight energy and healthcare. Consumer staples, we did well. We sold out. We may buy back in if we get more of a sell-off. We've been underweight utilities, bonds, and the REITs, and in fact, we're now short the index. Instead of going underweight, if I had my time again, I would have shorted the bond market. Anyway, here we are. So let's take a look at the S&P versus Crassus. So the S&P is finished year to date down here. We're slightly above that, just at about 9%. So we've got about 4% alpha. I'm not happy about it. It's not something I'm bragging. It's just a fact as to where we are, where we could be. That orange line here is the IEF, which tracks the 10-year treasury. So we've seen that perform poorly. This is the price of the bond. So as the yield rises, or the price falls, the yield rises. And so bonds have been down, or the bond trackers have been down about 9% already year to date. Is the CAPE ratio for the S&P 500. So the cyclically adjusted PE ratio, so versus the average of the last 10 years. Here we are at a very high point at 20.88. We expect that to come down another 20 or so percent. I was listening to a great interview by Christopher Joy, who's Australia's best fixed income, maybe one of the best in the world fixed income fund managers, and has been absolutely spot on over the last 18 months. He's targeting a mean reversion to around about 14 to 16 times PE, which is typically fair value for the stock market, historically speaking. So we probably got another 20% to drop in terms of the valuations. And this is where at around 13 times, we've been buying down here, even at the peak here when you had quite a lot of hysteria, okay, over the last 2 years. We never got sucked into paying way too much for these companies that weren't earning enough. Okay, so we've never gone out and paid too much, and we'll see what happens on the way back down. If we can continue to add to our solid businesses at lower multiples, we'll definitely continue to do that. And when you use this strategy, you're not worried about multiple contraction because you're getting the earnings and the cash flows. And in fact, you put yourself in a good position when things start to look up a little bit, credit conditions ease, and people start to bid up these multiples. The multiples expand and they pay more for the earnings of given companies. You will actually benefit in a double whammy. So if they're growing their earnings and they're growing in terms of the multiples that people are paying for the companies, you win both ways. Key targets, the bond market, okay? So it's been on a mission. This is the yield, okay? So as this rises, the price is falling, okay? So just keep that in mind. And as you can see, I don't know why I didn't short this bastard of a thing. I mean, I did for a little bit and then I took it off. But anyway, it is what it is. I wanted to just focus on the basics for eToro. I didn't want to get too fancy. And I probably should have just backed my skills. Anyway, we're here at around about just under the 3% mark. I did this yesterday, so it has actually ticked over 3% since. And Christopher Joy is targeting around 3.2, 3.25%. I think we could even go higher. Who knows? There's a little bit left in the in rising yields. Here we're looking at Fed funds versus the 10-year. Okay, so what's the difference between the Fed funds and the 10-year, and what could that mean moving forwards? So if we come back to just after 2019, Jerome Powell came into office. 2018, we had the Christmas Eve massacre, and this was as high as he could raise. So he's on a mission here trying to raise rates, the Fed funds rates. And then things broke. The market sold off heavily because the discount rate was too high, and the corporate bond market started to suffer because interest rates were rising. Normally here you can have, at the moment, where you see a 2% delta. So what's going to happen is the Fed going to be able to raise that up without the 10-year moving as well. Maybe, I don't see how. If they're stopping their quantitative easing by buying up the bonds, I don't particularly see how they can do that. So if they do get back to where we were in 2019, that would be a Fed fund rate of, let's just call it 250, okay, 2.50. If you then have a 2% delta, that would put the 10-year at around about 4.5, which would mean we've got another 150 odd basis points to go in terms of the yield rising. And that's when we could really see further sell-off. Let's take a look at the credit spreads. Okay, so the 10-year versus 2-year. If you want a good insight into this, look at Alfonso Pecatiello's Macro Compass. It's a fantastic publication. He knows a hell of a lot more about the bond market than I do. Here we've got the 10-year and the 2-year, and we should have a difference. As I said, for a normal yield curve, the interest that's paid for further duration maturities should be higher than those at the start. And as you can see here, we've got a gap that's now converging due to that flattening and then perhaps inverting of the yield curve. So depending on which way you look at this, you could look at this and say, these spreads have converged and you think they're going to revert to mean, in which case you'd go long short. I'm not doing this and I'm not recommending it. It's just an idea. Alf, on the other hand, thinks that things are going to get a lot worse before they get better. And he's going the opposite way. And he's looking to, he calls them flattener trades. So he's betting that this convergence will continue and we may even get an inversion. Okay. So if you're going long the 10-year, the yield will drop. And then if you're going short the 2-year, the yield will rise, and then you'll have this convergence. So that would essentially be the opposite of shorting the 10-year, expecting it to rise, and then long the 2-year, expecting the mean reversion. So it'd be interesting to see what happens. But as I said, I'm not playing in this credit market. I'm looking at other opportunities. Okay, so what is that spread normally? How much distance should we see? So here you've got a graph since just slightly before 2000 showing the difference in that 10-year minus the 2-year. Okay, so it's measuring the difference here. And the highest you get is 2.8, 2.7. And then we've got down to negative, which is where, you know, the 2-year is paying out a higher yield than the 10-year, where things are very sick, where you get this sort of inversion. So here we are recently, post-COVID, we got up to 1.5 and we've just started to tick over. This comes from the Fed St. Louis branch. And what's going to happen? Are those spreads going to widen again back to where they were? It'll be interesting to see. Obviously, I don't know the answer. What this is suggesting, if you think that the yield curve is going to stay flat, is that you think that the 10-year is going to stay around about where it is, and the Fed funds is going to continue to creep up and then potentially cross over, or you think that there's going to be this ripple effect and passing on higher interest rates, and so you're going to have the 10-year continue to rise. We'll see what happens. So where's the value? Okay, I promise to show you, where's capital coming from? We can agree it's coming from the bond market. The question is, where is it going? So historically, over the last 5 years, here's the S&P over the NASDAQ healthcare index. Healthcare is looking very cheap on a relative basis, okay? And the midway point roughly at 3.6 here on the ratio. that would suggest the higher this number is, the more units of the healthcare index you need to purchase the S&P. Or in other words, the higher the S&P is valued relative to the healthcare index, or the lower the healthcare index is valued relative to the S&P. So the higher the number here, the cheaper healthcare, the lower the number, the more expensive, if you want to look at it that way. And I think we've got a long way to come back down. So we're looking at initially, when the sell-off occurs, if I want to take my shorts, hopefully at a profit, and then roll them into long positions, healthcare will be a sector that I'll be looking to get back more exposure. If we look at the sugar index, okay, same deal over the last 5 years on a percentage basis. So to get back to that sort of baseline, we're looking at 40% increase in the price of sugar relative to the S&P. Platinum on the same metric around about 68%. And so, as you know, I've taken out a position in both sugar and platinum futures as a kind of diversification play. And I think that there's value there. Bad timing in terms of the yields on fixed income increasing. So again, that's probably me being a little bit too cautious and being behind the 8 ball, but we'll see. I mean, in terms of where I see this playing out over the next 3 to 5 years as a time frame, I think we'll be just fine. Similarly, uranium. I mean, come on, we've got a long way to get back to that, even to that midway point. Uranium would have to rally almost 200% against the S&P relatively for us to get back to a median value. So how am I positioned? Overall, here's the structure of the portfolio as it currently stands. So we've taken out some leverage. I will take out as much as 130% if I deem it appropriate. So our long equity makes up 78%. We've got a short book of 12% weighted value, and that's all in indices at the moment. Okay, so the S&P and the NASDAQ 100. 13% is in commodities, but if you adjust for the equities we own, they're exposed to commodities, so the oil producers and uranium ETFs, etc. You can add that 30%. So we're very heavily based into commodities. I expect that to cool off a little bit in the short term with fixed income rising, but then I think that the supply chain is so messed up, it's going to take a lot longer than people realize for that to start to heal, basically. And we're running about 7% cash. Okay, so that's the architecture. And in terms of valuations, I really wanted to point this out. If we're looking at how much other people are paying for their stocks, okay, how much your super fund, if you're in Australia, your Roth IRA, 401k in America, and you're paying these absurd valuations where their yield, so the yielding on the S&P, the cash you're getting back is only 1.9% of the value of that index. So you're buying the index, okay, you're buying your rental property for 100,000 as a numeraire, you're getting 1,900 back every year in terms of your rent. Versus the Crassus portfolio, we're buying our portfolio, if you want to call it that, you're copying the portfolio. And if we use 100,000 as a numeraire with our real estate example, we're getting back a free cash flow yield of 11.41%. So you'd be getting back $11,410 every year in cash. So whatever's happening to the nominal price, you're not so concerned. You're getting a great return on that investment, okay, from the cash flows alone. And that's what I'm trying to show here in that, see if I can go back, guys. I've calculated the mean PEs and the mean free cash flow yields. Okay, so you can see it's when we don't hold an overvalued portfolio, not by any means of the imagination. Thanks for that. I know it's slightly longer, but I wanted to cover the whole macro perspective and give you an insight as to what I'm thinking moving forwards and how we're going to be positioned to take advantage of that. Thank you to everyone who's copying the portfolio. Yeah, I've had great experiences. People have had a hell of a lot of confidence when I've been speaking to them. So, yep, no worries when you're doing well. They're really happy. And then when you have drawdowns and I'm explaining things to them, they're like, yep, we're not worried about the day-to-day or month-to-month, week-to-week fluctuations. We're positioned well. And so I really appreciate the trust and the confidence that you've had in me. And following me on Twitter, guys, at the ROI channel, I'm getting a little bit more active in terms of my tweets. And If you want to see more of this content, by all means, like and subscribe. If you're interested in a particular topic, put it in the comment section and I'll do my best to address it. Otherwise, as always, standard disclaimer, I'm not a financial advisor. I don't know your situation. I'm just sharing my opinions. Everything on this channel is my opinion, and I'm sharing what I'm doing, okay? Just because I'm doing it doesn't mean it's appropriate for you, okay? So please don't mistake anything on here for advice. It's simply my opinion and what I'm doing, and make sure you take responsibility for your own decisions, seeking out professional advice that's appropriate for you. Having said that, I hope you enjoyed it, and I look forward to seeing you in another video.